It's 5 o'clock in London, midday in New York, midnight in Hong Kong, 4 a.m. in Sydney, and 9 a.m. in San Francisco, 10:30 at night in Mumbai too. Greetings, good morning, good afternoon, and good evening, depending on where you are in the world today. My name is Patrick L. Young. The IPO-VID Livestream, Series 27, episode number 4. In the aggregate, that brings us up to episode number 160 starts here. And first of all, let me apologize, ladies and gentlemen. We are not live today due to a quirk in my schedule. I should be in flight as I'm talking to you, so therefore we've recorded this show slightly earlier. In other news this week, well, what can one report? There was an American election, ladies and gentlemen. I know they kept that very quiet, didn't they? It was such a surprise. What can we draw out of that? Well, some interesting things. First of all, bravo to Kalshi. Prediction markets, regulated prediction markets, worked really, really well. $200 million or more was balanced just on the market over who would be the overall victor. And actually, Kalshi pretty much beat the overall opinion polls. It came out somewhere around 51, 52% in favor of Trump, around about 48, 47% in favor of Mrs. Kamala Harris, which actually was pretty much where the popular vote lay, as opposed to the opinion polls, who had yet another bad election. Elsewhere, interesting to watch what's going on with this whole crypto business. Look for Senator Moreno. He ousted the Senator Sherrod Brown, who was actually the head of the Senate Banking Committee under the Biden government. That was quite a shock, I think, for many people. Will it be a big move for crypto? I'm not so sure, because it seems to me that with such a huge majority won by Donald Trump, he's maybe going to be beholden to other and larger groups of interested parties rather than necessarily running to the crypto bros. We shall see. The one thing that is clear, of course, ladies and gentlemen, is we're going to be looking forward to a new chairman of the CFTC and a new chairman of the SEC in due course. Wherever you voted, well, all I can say is thank you for voting, and it was an incredible US election once again. Our guest today is Mick Heyman. The topic is a wonderful concept, Mellow Your Money. Mick Heyman, CFA, is the author of Mellow Your Money, How to Surf the Market and Build Wealth Without Stressing Yourself Out. He's the founder of Heyman Investment Counseling. With a distinguished 40-year career in wealth management, Mick has built a reputation for helping individuals and institutions grow and preserve their wealth through a stress-free approach to investing. Mick, welcome to the show. Where in the world are you today?
I'm in San Diego, California today. So it's a nice, pretty fall day for us, 65, 70 degrees, sunny out, and the waves are rolling in nicely. And it's a little different than the rest of the world, but it's a beautiful day out here.
Absolutely idyllic altogether, and thank you very much for joining us in what is still reasonably early in the morning, but I'm glad you're having a beautiful day on the West Coast. That's absolutely marvelous. So tell us a little bit about yourself. I mean, how did you get into financial markets in the first place, Mick?
So my introduction was really as an internship during college, and I was just looking for a job. And if it depends on the age of your audience, but back then in 1980, the markets were not a friendly place to be. Back then interest rates were rising to 14, 15%. Real estate was booming, oil and gold were booming, and the stock business was thought, people snubbed their nose at it and were asking me, Mick, what are you doing? But there was something about it that really attracted me to this firm in Cincinnati, Ohio. And, after college, they said, why don't you join us? And even though part of me was excited about the sex appeal of trading stocks and making money. And back then there was a great show, Wall Street Week, with Louis Rukeyser. And of course, the dream was someday I'm going to get on that show and show them how smart I am. But what I found was it was really about helping people. And it was more about long-term investing than about trading. And so my start was a little bit different than what I thought it was going to be at the beginning, but it was a great introduction to the markets kind of before this great boom that we've had. If you can believe it, the Dow Jones was at 1,000, had hit 1,000 in 1966, and was still at 1,000 in 1981. So it was a different world when I got in the business.
And it's quite incredible, as you say, because stocks at that point in time could be, I mean, there were quite high dividends. There were cases of stocks returning 10 or 12%, but actually people were going, nah, I can get that anyway by basically buying a money market fund. I don't have to worry about it in this wildly inflationary environment, let alone real estate, etc. It was such a different world in the early years of the Reagan presidency before the mega bull market really got going.
That's exactly right. And we literally had I remember talking to a new client one time and he said, what are you doing at my house? I don't need you guys. I can make 15% in CDs. And I remember my boss arguing, those CD rates could decline. And they could go down to 12% or 10%. Well, that still didn't work as an argument, but if he had said CD rates could go down to 1 or 2, where we saw them a couple of years ago, he would have been locked into an asylum.
Yeah. Yes, so they would have locked him up for saying 1 or 2%. Now here where we are is a generation or so later, a couple of generations later, and you've got a realm of interest rate traders who actually think interest rates at 4 or 5% are pretty toppy and high, and they're starting to go all cold sweats over how high interest rates are. And it's like, guys, if you looked at the 1980s, I mean, good grief, I can even remember well into the 1990s, interest rates peaking one day at 17% during the last sterling crisis. I mean, it's incredible how people take for granted relatively low interest rates these days.
It is. And I think that having that perspective of history is so important because people forget. They forget when markets decline or rise on different things. And the constant phrase is, well, this is different. And if you go back, and I was actually forced to go back early in my career, back in the 20s and 30s, to get data out of the computer. And of course, I'm reading the headlines. And it was fascinating to me that in the depths of, say, Pearl Harbor, where you thought, I wonder what the markets did then. And you realize that was actually the bottom of a market. And it just gives you the perspective that things do change, and yet our emotions don't. And our reactions to things don't. But I think that perspective of history and where things have been and where things could go is so valuable for whether you're a long-term investor or whether you're a trader.
Yeah, I mean, it's quite incredible when you look at it. As you say, I mean, that great Rogoff book, This Time It's Different, and it's not different. I mean, we just see permanent cycles through markets as you go along. So advancing the conversation a little bit in terms of your career timeline, how do you end up, I mean, going from, sorry, you said you were in Cincinnati, Ohio, I think, and then you end up in the West Coast in San Diego?
So I took a little bit of a detour in the 90s, working for an institutional investment firm in Louisville, Kentucky. And I was newly married at the time and thought, well, we'll stay here a couple of years and I'll learn the institutional business. And that's where you're working for large pension plans or foundations and some union plans. And but it was at the beginning of that bull market in the 90s, and our firm was doing fantastic, and the whole experience of working for big committees was kind of just a different thing for me. And so the way that worked, though, our firm did so well. We ended up, I was a partner at the firm at the time, and we were able to sell out. Ironically, the timing, sometimes you get the timing right accidentally. And we sold out early in 2001, of course, right before 9/11. And but that allowed us to have some financial freedom. And when I think back to that, none of us knew at the time, of course, what was going to happen. But the timing of that sale allowed us to look around. And even though I stayed in Louisville for the next 2 or 3 years, my wife and I were thinking, let's not spend the rest of our life in Louisville, Kentucky. And we looked on the West Coast and found this wonderful place in San Diego, and the boys fell in love with the ocean. And it's just been a very good place for me ever since.
Well, it's certainly a magnificent lifestyle. So that's one thing that it's got going with it for it, with the incredible water temperature and everything. So you started then after that point in time, when you moved to San Diego, is that when you started your own company, Heyman Investment Counseling?
Yes, and even when I was in Louisville, there were some clients I knew from the 80s that said, Mick, can you just manage our money? And the company in Louisville said, yeah, go ahead and help those people out. And so when I moved to San Diego, I had a little bit of a head start with some clients I was already knew. And then slowly but surely decided I just I wanted to go back to my roots, and my roots were helping individuals. And so that's what I've been doing for the last, 15, 20 years, really, is working with individuals in San Diego. And but I'm a one-man shop, and you can't work for everybody. And of course, that led to thinking, nah, maybe I'll write a book and see if see if more people could be helped, at least with long-term investing kind of stories.
Well, that's a great segue. Thank you very, very much. Because I mean, let's hear a bit more about this. I mean, it's a beautiful Californian vibe title, Mellow Your Money. How do we go about mellowing our money then, Nick?
Well, and I know some of your listeners are probably moving a little faster than what I describe in the book. But what I found early in my career, I actually had my first client. You couldn't sell any stocks because of the capital gains, and we were comparing her returns to some of the people we were trading for in the early '80s, and invariably, LOEs was outperforming everybody, and that was my first lesson in sometimes it's best to hold and best to sit as opposed to trade. And in fact, there was a great trader back in the early 1920s that wrote a book called Reminiscences of a Stock Operator. And if you actually Google Jesse Livermore, you'll find, just the site would be Googled with quotes of great trading quotes from him. But one of his great ones is, I never made much money from trading. I made money from sitting. And so this whole concept of long-term investing and what it takes psychologically to do it is something I wanted to pass along, and kind of trying to at least a little bit mimic that book from Jesse Livermore. I wanted to do it through my stories and through my experiences. And so it's not a textbook that I wrote, but it's more of a memoir that through many of my misadventures and lessons in my life and things that I learned about the market during those experiences.
And that's an absolute classic book. I mean, that has been a book of the week before a long time ago. Reminiscence of a Stock Operator under the pseudonym of Edwin Lefebvre. Absolutely gripping book. I remember getting a copy of it actually very early in my career in the 1980s, and I went around to Trinity Church, just around the corner from the New York Stock Exchange, where they managed to marry Anglicanism with stock marketism, and they had a great bookstore inside, and I remember picking up a copy of it there. It is a superb book, and that's a great point you make, that you make a lot more by sitting than you do by most other means. So with Mellow Your Money, that's kind of where your inspiration came from. How did you develop your thesis of how you were going to go about investing and mellowing your money?
So what I wanted to do is kind of teach people that it is through your experiences that you learn your most valuable lessons. And so I kind of wanted to both pass along some of my experiences, both in and out of the market, and then teach some of the concepts that have helped me through the years be a little more calm and mellow when times get rough. And so what occurred to me as I'm writing it, and I was kind of developing the thesis as I was, writing down these stories, was that it often is one's psychology that can get you more than the markets. There's a great quote, I can't remember right offhand who said it, but they said, if you don't know yourself, the markets are an expensive way to find out. And I find that if you anybody Googles, what are the top things you need to know about managing your portfolio, the rules are right there. It's not that complicated. What's complicated are the emotions, because just after you kind of get things set up and you think, okay, now I can sit back, something happens. Maybe it's the pandemic. Maybe it was 9/11 or the financial crisis. And all of a sudden you're thrown into this whirlwind of emotions. Oh my gosh, what do I do? And so if you don't get in touch with your emotions at the outset, you're going to make these mistakes going forward. And so that's part of what I was trying to pass along in the message of the book.
Very interesting. And therefore, it is a whole case of you do just have to be mellow. Rather like a good surfer, you've got to sit back and wait for that wave to come to you rather than paddling around the place desperately trying to get every wave that happens to be thundering towards the shore.
Well, that's right. And actually, I now my kids would never say I'm a surfer, but occasionally I can catch a wave. And when I was first learning, one of the analogies I was drawing to it was um, my attention was on the ocean. It was on the craziness of the waves or the chop or whatever was going on. And of course, when your eyes go down into the ocean, so do you. You know, your body follows your eyes. It's when I was looking at the shore, I finally could get my head up and look forward. That's when I had that moment of bliss, let's say, of getting up on that surfboard. And what it reminded me of is same thing with the markets. If you're looking at all the turmoil, the day in, day out turmoil that's going on, it's going to get you. And it's going to get you to potentially make bad decisions. But if you look to the shore, if you look to that long-term objective, all of a sudden you can calm down. And so that was part of the analogy of the book too.
Very interesting. So, I mean, tell us, you've outlined a couple of great stories so far in the book. I think the book's quite full of some fascinating stories about investment tales and so on. What's the most memorable that you'd like to share with us?
Sure. I think, you know, one story that stands out was actually a basketball game I was involved in, and you would never associate me with being a good basketball player, neither would my coach or my teammates. But I happened to be the guy that got into the game, you know, late in the game, and you know, if we were ahead or behind by a lot, and at this point we were getting crushed, and the coach had me in the game, and but at some point in the fourth quarter, he calls, you know, timeout, and he is furious. But he's not furious at us. He's furious at the other team because they were rubbing our noses in this game and trying to get to 100. I think at the time the score was like 94-24. And he's thinking, this is just not good sportsmanship. Maybe we should walk off the court, is what he said. And then for some reason, and I don't know why, maybe it's because we had developed a relationship from me sitting on the bench the whole season. He looks at me and he says, Mick, what do you think? And for some reason, I blurt out, well, maybe, coach, we could try to hold him under 100. And he says, yeah, that's what we're going to do. Mick, sit down. Of course, you know, he wants our starters back in the game. And of course, those next few minutes were furious. And but in the end, there was no time clock. We were able to stall out a little bit. And the final score was 99-28. And we charge off the court like we had won the Super Bowl. And the fans are throwing stuff at us, and you know, everyone's booing, and the other team's upset. And you know, the coach at the end of the year said, you know, we had a lot of good games and some tough ones, but that's the game you're going to remember the rest of your life. And he's right. And as I'm thinking about that story, and I'm thinking, how does that apply to the stock market? I'm thinking that's a relative victory. We didn't win the game. We won in that moment. And so the lesson I learned from this is that relative victories are important. And we underestimate that, especially maybe all over the world, but I'm thinking in the U.S. at least. It's always go for the gold, be the winner, be the you know, get the best. And yet in the markets and in our portfolio, it's really relative victories that are what's going to help you over the long term. There's an old thing, at least in the institutional business, they always said, if you're the median manager, you don't have to be the top manager, but if you're the median manager every year, you hit the middle, you hit the ball in the middle of the fairway, over 10 years, you become the top manager because you don't have the highs and lows. And the same thing with individuals. If you don't try too hard, if you do that long-term investing and just focus on that long term, and don't get so distracted with trying to do all the popular things that people are talking about all the time, that relative victory is going to get you the long-term victory in the long term. And so, that's it was a kind of a fun story in my life. But what struck me is that we don't always have to be the top. That the relative wins are really what get us. And it's a hard thing to think about because we don't grow up like that. We grow up thinking, I've got to have the best performance, or I want to have the best stock. And really, it's investing is not about that. It's about, just being consistent over the long term.
So it's a really, really interesting example because wherever you're looking with what's going on with that sort of process, I mean, this quarter's results are a great example. Intercontinental Exchange, they put in, again, a good set of double-figure results, but they're always putting in consistently good growth numbers. And over time, that does make for an incredible compounding experience. So, I mean, you mentioned, what was it you were talking about at the very start? I'm going to say Beanie Babies, but actually it wasn't Beanie Babies you were talking about. Tell me.
I think in a previous conversation we were talking about the meme stocks, and I realize cryptocurrency has some staying power, but but they are tradable, and for the average person that doesn't know how to trade and doesn't know how to use stop losses, and just to note, I'm not one of those people either. I learned early on that long-term investing was my path to success, and not trading. But Beanie Babies we talked about because fads happen, and the old lesson, what was it, back in the 1500s, the tulip bulb crisis, where the tulip bulbs were potentially different. Tulips were being sold like houses back then, and you read that story and you think that's ridiculous. How could people have looked at tulip bulbs and treated them like investments, or that at some point you could trade them for a house, and yet here Beanie Babies were being bought and sold in the 90s like that. And so the more things, as we say, this time is different. Our emotions are not much different than those people trading tulip bulbs, back in the 1500s.
Quite fascinating altogether, yes. And in fact, just recently I had the opportunity to go and see the Dutch auction at work at the Royal Flora Holland exchange, which is quite incredible. It's the same size as the Principality of Monaco, just trading flowers.
Wow.
Quite
Wow.
an amazing undertaking. 60% of all the world's export flowers going through a set of 32 different clocks. And actually, we've got a great short video about that, which we'll bring to you one of these weeks, ladies and gentlemen. But yeah, 1636, 1637, the peak of the tulip mania, something quite incredible. The Amsterdam Stock Exchange is an epicenter of the world. Have you ever read, as a matter of interest, because you talk about Jesse Livermore's book, did you ever read the book Confusion de Confusiones by Joseph de la Vega?
I've not read that one. That sounds fascinating.
That's a great book. That's another group. Now, so that's written in early, sort of sometime 17th, 18th century. I think it's about 1720, if I remember correctly. So into the 18th century. And he was a Sephardic Jewish merchant who'd come up from sort of the southern end of Europe in order to manage to trade in Amsterdam along with a group of other people. And that's a really, really interesting book, talking about the world of markets and stock markets and how they were put together. And the thing is, you're talking about this time it's different. You could actually read that and then go to the Chicago Board of Trade 20 years ago and go, hey, I know that guy. That guy definitely, I just read about him in a book. And then you'd realize it 300 years old when you were actually thinking of him, but he looked just identical and behaved in the same way. So
That's
therefore,
fantastic.
it is fantastic. And I mean, there's a lot of stuff therefore that we see. So, I mean, you mentioned briefly sort of this issue about crypto and things like that. I mean, it's obviously one of the things I always think is difficult is, when do you decide that something that has been very much a faddish kind of thing, like Beanie Babies, has become a security, something that is actually good for the long term?
Tough question, actually, and we have some great examples, actually from the technology side, because imagine back in the 90s, we mostly were able to avoid those faddish internet stocks that disappeared, in the early 2000s and such. But you look at one of them was Amazon. And the amount that Amazon was going up back then, and you thought, this is a bookstore. What are people doing? And of course, back then it was mostly a bookstore. But over time, you saw, this is more than a bookstore. And when you do realize these things, Amazon had appreciated many, many fold when I finally figured out this is for real. This is a real company. And yes, the price earnings ratio is high. And yes, it's up a lot, but it's for real. And so I think when you visibly know what they're doing and you kind of get a feel for that business, I think at that point for me, it's worth putting money in. I wasn't an early investor in Apple Computer. And of course, I was probably a late, it was my kids that taught me how to use the first iPod. And I think it's pretty cool, but Apple at that point was pretty expensive stock. And it took me a while to figure out you gotta dip your foot in because this is for real. And I suppose with cryptocurrency as an example, you have to see what is it actually being used for at some point. Is there something out there that's really going to make it go? And personally, I haven't seen it yet, but as old as I am, I've realized you have to keep an open mind because if you ever say you never say never because at that point something is going to happen. So I'm keeping an open mind there, but I haven't seen it yet. But I think that it does bring another point that I think is really important is you have to know what you own. And if you own cryptocurrency right now, you have to realize these are pretty volatile and you don't really know exactly what it is, what fundamental is going to drive these things. At least for me, I don't see it. But even if you own say you have an S&P 500 index fund, I encourage people, know what you own. Look inside that fund and look at the stocks that are in there, because that's going to help you when that index fund goes down. Invariably, we're going to have a correction. And we just had one a couple of years ago, down 20%. If you looked inside that index fund and you saw, oh, it's Microsoft and Apple and Procter & Gamble and Pepsi, it makes you relax when you actually know what you've got.
Yes, and it's very important as well for people to understand concentration risk when they're in an ETF or something that's investing in an index, and suddenly you end up with half a dozen stocks are essentially dominant in the whole pricing debacle. I mean, we saw this in Spain in the run-up to the dot-com bubble as that was imploding. What was it? The Spanish telecom monopoly was essentially something like 80% of the index, if I remember correctly, out of 30 shares. It's absolutely astounding. And that certainly can be a tip for you, even over the long term, to realize that you need to try and find benchmarks that reflect what you think rather than just blindly following the Dow or the S&P at all points in time.
And if you've got a money manager working for you, you've got to talk to them and understand what they've got. There were funds that were called back then they were called core funds, which is, something that you'd say is conservative and would match the S&P 500. Well, some of those funds back in the early 2000s had 75% in technology, kind of like what you were talking about with Spain. Well, if you hired a manager and wanted a conservative fund, you weren't getting that. And so that is part of the it's the impetus on all of us to know what we've got. And, if you own a company, know what they're doing and that kind of thing.
So, I mean, that brings us to a very interesting point, actually, because this week in our short video, we're going to show you a little discussion about the excitement of the US markets, because NYSE Arca, they filed, they want to go 22 hours a day, 5 days a week, something that's obviously going to appeal to a lot of traders who are insomniacal. Or is it? What's the message behind this and why is it doing so? Well, let's catch the short video and find out.
Meanwhile, in Big World, why on earth does someone want to trade American stocks 22 hours a day? The truth is, it's not the same person. There are myriads of people around the world who want to be part of 60.5% of the entire world's market capitalization. US stock markets are therefore, the proposal from NYSE Arca is to open 22 hours a day from 1:30 in the morning to 11:30 at night. That's been driven by Blue Ocean Technologies, who open 8 o'clock in the evening to 4 in the morning, and they dovetail beautifully with trading in Southeast Asia. Millions of Koreans, people in Hong Kong, people in Japan are eager to trade the US stock market. Let's give them the opportunity. Let's globalize the US market. After all, it's the globally dominant market in the world. For more in Big World, like or follow.
A very, very interesting view there. Blue Ocean, incidentally, had a record day. I think they did something like 5 times their usual trading volume between Tuesday night and Wednesday morning. I wonder what was happening between the 5th and 6th of November, ladies and gentlemen. Yeah, the Trump trade was real. A lot of people were jumping in, and actually, of interest was that I do believe it was Tesla was by far the biggest stock trading on that platform during the course of that evening. Let's see how the Doge, that's the organization, or at least the nickname that's been given to the entity that's hopefully going to help reduce pleasantly the size of the US government rather than being the Dogecoin of the dog. Now, speaking of barking instruments, apart from the one that's in the background today as I'm recording, don't forget, ladies and gentlemen, if you want to stay posted on all that's happening at the Exchange of Information, do subscribe to Exchange Invest. You can sign up at exchangeinvest.com. Subscriptions are starting per user license at $499 per year. And let's face it, when you consider how much money you spent on newspapers to tell you the wrong thing about this election, it might not be a bad investment. Back to our fabulous guest today, Mick Heyman, talking about Mellow Your Money. Relates to your book, all of those different issues. We're talking a lot about sort of long-term trades and how they impact. We're going through cryptocurrency and so on, which I think is very, very interesting. However, you hit on something there. You're talking about these instruments where you might end up with a lot of exposure to something you don't really realize because you're buying an ETF, which is, say, a very high-tech component or something like that. How do you focus on balance? How do you work on diversifying a portfolio for your clients?
For me, it really starts with risk tolerance, and that's something that is fairly unique to each person, and can be a little different. That for me, each person has that point where they might get scared, and you need to make sure that you don't take, whether it's stocks or bonds or whatever it is, that you want that balance to make sure that when unexpected things happen, and it's invariable that things will happen that are surprises. When that happens, that you have strong hands, and you're actually willing to take advantage of those as opposed to get scared and such. So there are clients that are older that don't need the stock exposure, but they have strong hands, and they're 70-80% in stocks, and they're happy with that. And when the market goes down, they're not scared. It's like, let's buy a little bit more. And that's them. Other clients, they're 50% in stocks, and they could be higher. They don't need the income, let's say, from bonds. But I know, and they know from experience, that if the market went down, they'd get scared. A lot of that can be figured out on the outset, because if you have $1 million, you can figure out, well, if that $1 million is all in stocks and the market goes down 20%, how do is that going to make you more aggressive or more scared? And so each person, I believe, needs to come up with that psychological component of how much risk can they take. And I think that's really important from the outset. And then after that, then all this volatility that happens in the markets, you can use to your advantage if you're a long-term investor, because you've got strong hands.
Strong hands, a vitally important facet to this market at all points in time. And I'm just curious, do you use any shorter term hedging transactions? Do you have any derivatives exposure, anything like that? Or is it mostly all just single stocks, funds, bonds?
Yeah, for my clients and for my way of doing things, I've just used the traditional investments, and it is curious to me that of course at any given year there can be hedge funds that do fantastic or not. But if you look at the long term, to me, most hedge funds underperform a traditional, say, call it 60-40 portfolio. That all that trading that goes on, you got to work hard to outperform just traditional investing. And so I would encourage, if you're a trader, and I've had an uncle who was a great trader, and it worked out really well for him. But you want to have an index or a comparison that you're sure that all this trading is actually helping you.
Right. So, how do you then go about analyzing and understanding what could we describe it as? Real risk versus, say, the perceived risk that you get in today's markets.
Well, and that kind of gets back to the I think what you were saying earlier about the underlying exposure in some of these index funds, perhaps. That let's say you think that you only have 50 or 60% of your money in stocks, but somehow you had some technology ETFs and whatever, and if you looked underneath it, you'd say, holy cow, half of that 60% is in Microsoft and Apple and Nvidia. And so to me, the perceived risk is, oh, I've only got 60% in stocks. But the real risk is, what did you have underneath that? The example I actually used in my book is a little different. There were clients that had this, it was back in the late 70s, early 80s, they had this oil company that was, they put a little bit of money in, for them it was $100,000. They had multi-million-dollar portfolio. That $100,000 grew to several $1 million because of the small Canadian oil stock. As it continued to go up, they continued to get more bullish on it. So every time we said, well, you ought to cut back a little bit, they'd say, no. Look at the earnings reports. Look at what the analysts are saying. It's a safe stock now. Well, it was an aggressive stock when they bought it. And later on, as oil started collapsing in the 1980s, that stock went from several $1 million back to their original investment and even lower. And all we got out of it was a trade we made, and we actually got criticized for it, where we sold $50,000 of it. And so to me, what was the real risk versus the perceived risk there? You think as something goes up, oh, it's safer. People are talking about it in a positive way, and oh, it's safer. And that's the perceived risk. But the real risk is, if you allow it to take over your portfolio, you really are vulnerable if it goes in the wrong direction. Right now, these tech stocks sound fantastic. And of course, I have plenty of exposure in technology too. I think it's growing, and it looks like it's the growth of our economy. And yet I look back in history and I say, don't get fooled. Even things that are interpreted as like the top companies can go away. Xerox, Polaroid. At one point, I just someone sent me a picture of it, that I believe IBM was 10% of the S&P 500 back in the early 1970s. Well,
Yeah.
it's not anymore. And so, be aware that any of these companies can hurt us, or, and so pay attention to it and take some money out of it once in a while. If Nvidia doubles, triples, I'm not saying sell it, but it doesn't hurt to take a little bit of money out and move it and diversify a little bit.
Very, very key point. And therefore, how about geopolitical risk? How do you put that or measure that in terms of portfolios?
What I've always said is that those geopolitical risks are so unpredictable that kind of goes into the original setting up of, be sure you're prepared for something that is unpredictable. And it's almost like the first time a surprise happens geopolitically, that's when the market gets hit. And that's when so the riskiest time was before you knew anything. And so be prepared beforehand that something unpredictable could happen. Once it happens, typically that's the safer time. A couple of times when, in the last 20, 30 years, when America has gotten involved in a higher scale war, the riskiest times were before you knew it was going to happen. But later on, the market bottomed and did quite well. And so, it's not a perfect answer, because all these things are unpredictable. But the important thing is, be prepared for the unpredictable before it happens, and that's with your overall exposure.
That's a very, very interesting point, and actually a perfect segue. Thank you very, very much, Mick, to this week's book of the week, Why Nations Fail, one of the recent Nobel laureate was awarded to Darren Acemoglu, and he wrote with James Robinson this book that conclusively shows why nation fails, the origins of power, prosperity, and poverty, that it is essentially man-made political and economic institutions that underlie economic success, or the lack of it, in different nations. And spoiler alert, Anglo-Saxon legal systems happen to be very good for property and therefore the growing of wealth. That's a fabulous book altogether. So I suppose, I mean, looking at all of your career, if you're thinking about this, Mick Heyman, we've been discussing Mick Heyman, Mellow Your Money during the course of this show, number 160. If you had one piece of advice you were going to offer to every investor that you can't deal with, or one piece of advice that comes out of Mellow Your Money, what is it?
I think the biggest thing that I've learned over my life is to keep growing from our experiences. So in other words, my greatest tip is not about something to actually do in the stock market. It's really to look at our lives as learning lessons. That these are chances for us to grow and learn and get perspective. And as opposed to always thinking, oh, I wish that hadn't happened, or boy, that person is really, not a, easy person to work with. There are lessons that even those most uncomfortable people can teach us about our lives and about ourselves. And if we can learn from those experiences, I think we can both be better investors and be happier people in life.
And that brings us to our last question of the day then. So Mick, tell us, where do you believe the capital market revolution goes next?
I believe that that we're in an environment where, even though, as I think you had mentioned earlier, that rates are higher than people had gotten used to, say a handful of years ago, that stable interest rates and potentially even slightly lower rates, if the Federal Reserve continues to lower rates a bit, lead to good markets. And so, not without a few potholes along the way, but I believe over the next 12 to 18 months, the markets can continue to be a friendly place to be. And as long as you don't get psychologically affected by that unexpected bump in the road that I also believe we'll find in the next 12 to 18 months, I think you stay invested right to your allocation that fits your unique risk threshold.
What a fascinating answer. Well, Mick Heyman, thank you very, very much for joining us this show. Sorry we had to record it, ladies and gentlemen, due to a few issues with my logistics. It's been a joy chatting. Catch a copy of Mellow Your Money when you get an opportunity to do so. It's full of fascinating stories about how to invest, and particularly the reasons behind why you should be investing over the long term with the core of your portfolio. Next week's episode is going to be the marvelous Louis-Jan Bontois. Actually, we were on a panel together just a couple of weeks ago in Amsterdam at the IFM conference. Really looking forward to chatting and catching up with Louis-Jan again. We're going to be talking about the evolution of markets technology, and it's going to be a very interesting show. He's now the VP of Housing Anywhere, but he's had a 20-plus year career building systems for exchanges and financial market operators. It only remains for me to say a huge thanks to our fabulous production team today. Thank you very much, Desiree, Jamil, Marianne. It has been an epic show once again. I want to say, finally, a huge words of thanks to our guest today, author of Mellow Your Money, Mick Heyman. Mick, I wish you a great week in life and markets. Thanks very much for watching, ladies and gentlemen. Have a great evening.